I got the example of Bob, right? So right here we have Big Bob. Bob is trying to leave some money behind for his kids. He got Bill, Lil Bob, and Bree, and he's trying to leave them something behind, leave them some type of inheritance, right? So Bob is wondering, how can I leave my kids something behind so they can have something when I'm gone, secure their future, right? So Bob says, maybe I should just go into Bitcoin and start getting some penny stocks and get some vending machines. And, he doesn't really know what he's doing. So he's kind of overwhelmed and hoping that it works. And if it doesn't work, whatever he's invested into the products is gone, basically, right? So Bob ends up running into somebody and tell him about whole life insurance and how he can use whole life insurance in order to secure his kid's future, right? So he gets a life insurance policy, and just for this example, Bob gets a policy for $100,000, $25,000 for his wife to pay for the funeral expenses and leave her some money behind. Then he has 25, 25, 25. So all the kids get $25,000 when Bob is gone, right? Guaranteed payout. Long as Bob pays his, let's just say for example, $80 a month because Bob is young, $8 a month for his $100,000 policy, everything is fine. And as long as he pays that every month until the day when he poofs, then it's all good. You get guaranteed a $100,000 payout, right? And it's gonna stay at that $80. It's not gonna increase when he gets older. Now, another thing that people don't really know about life insurance is that he has access to cash value, which is ACV right here. So with Bob, let's say 10 years in, Bob is 50 years old, well, 40 years old. Let's say 20 years, he's 50 years old. He realized he has about $20,000 worth of cash value built into his policy. Bob can take out a loan up against that $20,000 straight from the insurance company. Now, the cool thing when you borrow money from the insurance company is that they don't put you in a pay schedule. So it's not like, we're going to give you $20,000. You have to pay us back X amount of dollars until this day, and then on this day, well, until X amount of days until the loan is paid back to us. When you borrow it from the insurance company, you pay back at your own pace, right? And it's usually a flat, simple interest. So that if you had to use this money for like a real estate investment or something like that, you could take the money, invest into your real estate investment, and if you're making money off of it, you just funnel that back into your policy until that loan is paid off. You had nothing to worry about. Every anniversary of the loan, they'll charge you a simple interest, and usually 4 to 6%. Just to keep it simple, let's say it was $100. The anniversary comes around, they charge you $4 on that $100 or $6 on that $100. It's a low interest, right? So Bob does that. He can use the money, buy his kids a car, whatever he wants to do, right? Bob does that, and Bob doesn't stop there. Bob goes and he gets an insurance policy for each one of his kids, a $50,000 policy for the kids. Now the kids have the same thing, and the kids' policies are low. So let's say you get a kid 20-year pay or something like that, and it's $35. It's gonna be a level premium. If you get 20 pay, you only have to pay for 20 years, and you're done paying. If you just get a regular whole life policy for them, it might be $20 or something. You just continue to pay on it. $50,000 policy, whatever the amount of the policy is, right? You keep paying into it. It's a guaranteed payout. Something happened to them now when they got older or whatever, they're gonna guarantee payout as long as that premium is continuously being paid every month. They also have access to cash value. So what the kids can do is the kids can take that money and they can use it to buy their first car, pay for college, if they need to tap into for college to get books and stuff, or even use it as a down payment on their first home, right? So now with Bob having all this in play, he got the kids with their policies. So, not only is he leaving them $25,000 each, they also have their own banks to tap into, basically with their insurance policy, with the cash value that they've been building inside their own whole life their whole life policies, right? So now Bob, he says, you know what? I can go invest into the Bitcoin stuff. I can go get me some penny stocks. I can go buy some vending machines. And now he's feeling all right because, he's always had this security buffer behind him that's minimizing his risk, because that's what insurance is about. People think insurance is about just getting paid off insurance and all type of stuff like that. Insurance is really to mitigate risk. And imagine how less stressed he is knowing that at least he has his kids set up with something, rather than just trying to risk something on everything and not having any type of risk factoring involved. You know what I'm saying? Minimizing the risk that he's taking, investing, and trying to win for his family, right? So I just want to show you guys this about whole life, about the cash value, guaranteed payout and the level premiums, because a lot of people, they wait till they get older. Sometimes I talk to people and they're 80 years old and they're trying to get life insurance, and just to get a $10,000 policy, it's like $200 some a month, which is crazy, but it's due to their age. They're 70 years old, 75 years old, and all of a sudden they want to get life insurance. But now, you got all these different health factors and everything like that. It's best to lock in while you're young. Start it while you're young. That way you have a low premium and you don't have to get old and worry about trying to leave something for your kids. Imagine you got 3 kids, you're 75 years old, and you're trying to leave them some money, you leave them $10,000. What are they going to do with that? There's no, even right now, there's not a lot. Imagine 20 years from now how little